Hello and welcome back to Global Value. In today's video, we'll be performing a fundamental stock analysis of SBLK Carriers Corp, ticker symbol SBLK. At the time of recording this video, SBLK Carriers is trading for $31.25 per share. Their stock has done quite well year to date. They're up about 47%. Over the past year, they're up nearly 71%. Going back 5 years, they've returned about a 32.5% compounded annual return, killing the S&P 500 over that time. However, going back since their IPO nearly 8 years ago, they're down about 44%. SBLK Carriers is the second largest position in Oaktree Capital's public stock portfolio. Oaktree is the distressed debt firm co-founded by Howard Marks, who's one of Warren Buffett's, most admired and respected investors. Howard Marks produces a bunch of really insightful letters that he's compiled over the last 30 years. His most recent letter came out last week and offers some interesting perspective of bull markets and the market cycle more generally. So SBLK makes up about 8% of Oaktree's public stock portfolio. They've recently added about 1.6% of that, so their largest add in the first quarter of 2022, and so far it looks good for them. SBLK is just off of its 52-week high, double its 52-week low. They're a $3.4 billion market cap company. For some background about the business, SBLK Carriers Corp provides seaborne transportation solutions in the dry bulk sector. The company owns and operates dry bulk carrier vessels, which are used to transport major bulks such as iron ore, coal, grains, bauxite, fertilizers, and steel products. It owns a fleet of vessels that consists of Newcastlemax, Capesize, Post-Panamax, Kamsarmax, Panamax, Panamax, and Supramax. It generates revenues through the voyages it carries out. The company also provides vessel management services. SBLK Carriers Corporation was incorporated in 2006 and is based in Marousi, Greece. So we'll be performing an 8-pillar analysis as popularized by Everything Money, taking a look at 8 different financial metrics to come to a fundamental beginning and holistic understanding of the business. So with that being said, let's get right into our analysis. Starting off with pillar number 1, we want their average PE over the last 5 years to be below 22.5. So currently they're trading at a PE that's just over 4 times earnings. Over the last 5 years, their average PE has been about 6. Their earnings have been all over the place, and so this number might not be the most reliable, but it's their average. Nevertheless, pillar number 1 is going to be a check to start off. Next up, pillar number 2, we want their average 5-year return on capital to be above 9%. So one thing about SBLK that's different than some of its competitors is that in each of the past 5 years, they've had positive returns on capital. A number of other shipping companies have had negative returns on capital in a couple of these years, and almost all of them have seen big booms in 2021. Averaged out, SBLK Carriers produces about a 6.4% return on capital in an average year over the last 5. That's going to be your first X on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. They've done this. They've nearly 4x'd revenues in the past 5 years. Check on pillar number 3. Pillar number 4, we're looking for 5-year net income growth. Thanks to an outstanding 2021, this one's also going to be a check. They have nearly $680 million of earnings in 2021, which just absolutely blows what they've done in the past 4 years out of the water. So that's a check on pillar number 4 as well. Pillar number 5, we're looking for decreasing shares outstanding. We don't want a business to be diluting existing shareholders. Instead, we prefer that they're actually buying back shares if the business is reasonably valued. Here we can see that they've diluted existing shareholders by quite a bit. They had 63 million shares outstanding in 2017, and that's increased all the way up to 101 million in 2021. So this is going to be an X on pillar number 5. Shareholder dilution can be a silent killer for investors, as it ultimately means that you're entitled to a smaller ownership percentage of the business for each share that you hold in the company. So again, that's an X on pillar number 5. So far, we have 3 checks and 2 X's. Pillar number 6, we're looking for 5-year free cash flow growth. We see that here, they had negative free cash flows in 2017, and they've had $637 million of free cash flow in 2021. So that's a check. So since the pandemic, they've had positive free cash flows. They've also put fewer capital expenditures back into their business than they did in the previous years. Averaged out, Star Bulk Carriers produces about $51 million of free cash flow in an average year. But again, this is a highly cyclical industry, a highly cyclical business. And so they've had a lot of ups and downs, and this is definitely toward one of those boom periods. So that 5-year average is a way to kind of cyclically adjust things and have a more realistic picture of what this business can do in both its booms and its busts averaged out. So this $637 million was as of the year end at 2021. We can actually see that over the past 12 months, Star Bulk Carriers has produced about $845 million of free cash flow. So that is a huge amount of money, especially relative to what they've done in the past. So a major question that we have to figure out as investors, if we're interested in the business, is what is management doing with all this cash flow that's coming their way? Are they reinvesting it back into the business now that they're getting these high returns on capital? There's a delay in adding new ships to shipping fleets. So are they potentially contracting with shipyards to get more ships added to their fleets, which a lot of other companies can be doing right now? Or is management thinking about other things like potentially returning this money to shareholders or paying down debt? So really understanding how they're using free cash flow and which of those 5 things, paying down debt, buying back shares, paying dividends, making acquisitions, or reinvesting back into the business, are they doing with this free cash flow? So that's a major thing that we want to consider and something we need to understand in order to invest in the company. So pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. So they have $1.1 billion of net debt after subtracting their cash. Multiplying that average 5-year free cash flow of around $50 million times 5 brings us to just over $250 million. So quite a bit below what their current net debt is. Of course, their last 12 months of free cash flow has been this huge number, this nearly $845 million mark. So if they would continue to have those kinds of free cash flow generations into the future, then this net debt is super easy to pay off. They could pay it off in about a year and a half. But that's a big question, is if this free cash flow is sustainable going forward. So we need a deeper insight into the business than can be offered by just looking at their financials for that one. So with that said, pillar 7 is still going to be an X, but keep in mind that we need to understand their free cash flow profile going forward into the future to make a more accurate assessment about this business. Finally, the big pillar of them all, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 20. So currently they have a market cap of $3.4 billion. When we multiply that average 5-year free cash flow of $50 million times 20, that brings us to $1 billion. So that's $2.4 billion off of their current market cap. Again, if we're just looking at their trailing 12 months of free cash flow, that's $845 million. So they're trading at about a 4 times their trailing 12 months of free cash flow multiple right there. So if that number is sustainable, and that's a big if that requires more work, then they are trading at a very, very cheap free cash flow multiple relative to a lot of other businesses in the market currently. But you have to understand if that's going to continue. This is a highly cyclical industry, and we have to understand what the management is doing with that capital. Lastly, Star Bulk Carriers pays out dividends. So they have not consistently paid out dividends, but I still want to take a look at this dividend profile relative to their free cash flow to see what their dividend profile looks like. Is it healthy? Is it sustainable? Overall, throughout this recent boom, it looks like they're returning about 60% or so of their free cash flow per share back as dividends to their shareholders. So shareholders, especially over the last year, have gotten some really phenomenal results from this company. Before that, it was a good thing that they didn't pay dividends in 2020. I actually don't agree with this dividend payment in 2019, especially because they had such negative free cash flow. And then it's a good thing that they're not a consistent dividend payer because they haven't consistently been able to produce free cash flow from their business. So checking out how they're paying out dividends, they're using the majority of this excess free cash flow and just straight up returning it to shareholders. So whether or not that's the best capital allocation long term for this business, and the jury's still out on that, but in the meantime, current shareholders are getting some very high yields and very high returns out of Star Bulk Carriers. So in summary, Star Bulk Carriers checks the box on 4 out of 8 pillars. They operate in a highly cyclical industry, and we have to understand, what's the nature of this boom and bust cycle, and does the current boom that they're in continue going forward? We found out that management is allocating a large amount of their newly found capital. They have high amounts of free cash flow for the first time in the last 5 years coming in by paying back large dividends. They pay out about $4 of dividends for a stock that costs $31. So that's nearly a 13% dividend yield, which, might not be the most sustainable thing going forward, but is, making existing shareholders pretty happy. To get a better understanding of this business and think about, as a value investor, we're really not looking at businesses that we want to hold for anything less than a 5 to 10 year period. So if we're thinking about investing into this company as a value investor, we have to do more work here, and we have to understand, is management going to continue making shareholder-friendly capital allocations, and is this boom going to continue into the future? A prerequisite of investing in a business is taking an ownership mentality and really understanding all the nuances and all of the ins and outs and the essential nature of a business. And so if you want to dive deeper here and learn more, I highly recommend reading through their 10Ks and annual reports, and doing your general due diligence about the business and about the industry more in general. They've had quite the run-up in recent years, so I don't know how much of that is sustainable going on into the future. In order to tell one way or the other, you're just going to need a deeper understanding of the company. So this type of analysis is just a starting point, but at least it'll point you in the right direction and give you that financial oversight of the business. Well, guys, that's it for today's stock analysis of Star Bulk Carriers Corp, ticker symbol SBLK. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Thanks for learning about Star Bulk with me, and have a great day.